All right, so let's begin the show and let's get connected to our viewers. But then before that, today on the show as an expert, I have Anil Rego, Right Horizons. Anil, good evening and welcome to the show. And we are also connected with our first viewer, Ashish Marva. Ashish, hi, good evening. Happy Raksha Bandhan to you and hope you've tied up the Rakhi and you're done with the festivities. I see you can, you have sent us your question and your job stability is uncertain, which is why you want us to plan your investments. All right. Anything specific you want to add to your question? Because so far, even Anil has your query with him. Is there anything else that you want to add?
I think I've already given the details.
Sure. Okay. I just want to know the reason why you've selected the funds that you have invested in. Have anyone recommended you these funds? Have you done your fund selection on your own?
Yeah, it was done by me only, on my own.
Sure. Sure. All right. So let me not read out the question because that will take a lot of my time. Anil, what do you advise?
Yeah, so I think when you have a situation where say a job is at risk, it's important to also step back and see what is it that one can do to ensure stability. At the same time, it's also about looking at the long term, right? So because sometimes when let's say you are in a bit of a crisis, the mind becomes very conservative. So at such a time, I think taking help will at least help you take a more measured decision there. So that's one of my points. And maybe go through a bit of financial planning, because I think what you have here, maybe we can help you a little bit but not completely, right? So coming back to how to keeping 1 year monthly expenses and emergency funds is what we would recommend in a situation like this. But having all of it, say, in fixed deposits, which you also have said you would like to deploy into mutual funds, there I may go a little more conservative and possibly use, say, a balance advantage fund, which manages risk very well. So basically, in a balance advantage fund, the equity component is variable. So as markets go up, it basically goes into debt, and as markets fall, it goes into equity. So automatically buying low, selling high. So that's a good fund to do for maybe a substantial portion out of the 27 lakhs, maybe 15 lakhs can be done there. And for the rest of it, again, being conservative, in terms of a hybrid conservative, and let's say a quota debt hybrid fund is something that one can use. And so combination of these, I think, will take care of your requirements as well in case, things last, difficult times last a little longer, right? So mutual funds, I think we can then, go back and see, can we take a little bit of risk and look at a little bit of longer term and build up an asset base for the future. And there, it's good to say diversify across a large mid cap, multi cap, and flexi cap, and possibly even for a small part of it, see whether you want to take thematic funds. But that you can choose based on your risk appetite, and that's one thing that if you're uncomfortable taking too high risk appetite, then you can leave out thematic. So in the large cap side, I would suggest maybe say an ICICI blue chip fund. ICICI through large and mid cap can be in the large and mid cap category. Nippon you can use in the multi cap. Mid cap you can use on say a Motilal Oswal and Nippon for a small cap fund. Like I said, if you want to take a little bit of a additional level of risk, then maybe then you can look at an ICICI Pru infrastructure fund, but that ideally keep it to lower exposure there. So I think that having a balanced approach may be sort of a good thing to do. In terms of your existing funds, I think we can stay with most of them. Other than a couple of funds. Okay, so maybe a fund like ELSS Connect Saver is currently sort of a ELSS fund, and I think your period is over 3 years. So you can then go back and have it invested in a diversified equity fund, like say an Nippon India multi cap. Or if you want to keep it for liquidity, that's something that one can also do, along with or even a balanced advantage fund. So this is probably, as a high level thing that you can, go about it.
Ashish, I think Anil has answered this question in as elaborate way as possible. But is there anything else you want to ask him?
That's it. I'm satisfied.
Sure. All the best. Okay, so let's quickly take a smaller question. And but before that, Anil, if I just have to ask you one question on Ashish's behalf, the age is very important, considering that he is 50 years old and now he is looking at diversifying his other investments into equity. We still have no idea as to when he might want to use this money that's accumulated from this particular investment portfolio that you just recommended. How can one mitigate that kind of a risk, maybe if it is just 5 years, 6 years time horizon, because he is planning to move his money from a lot of safer assets and getting them into equity, even if it is a very hybrid or a conservative hybrid option that we are suggesting him, and not as aggressive as we would have done to a 24-year-old or 35-year-old. How can one strategize it in a simpler way and an easier way, Anil?
Yeah, so actually, first of all, which is why I also suggested a more detailed financial plan, because it's very, very critical to do. And first of all, define what is your ideal asset allocation that you should be following at this point of time. A simplistic way is to say, 100 minus your age, which is for a 50-year-old person, then you can have 50% in equity. If you're very conservative, then you can say, 80 minus your age. So then you get to a 30%. So I think somewhere in between 30 to 50% is where it's okay to have a long-term equity, because you need to also beat inflation, right? So that is where one suggested what one suggested. And but at the same time, do a systematic investment. In fact, whatever suggests in his portfolio, because he has say 25 lakhs invested in stock, right? Slowly, that is what you can continue to keep to maintain. And to that extent, then you don't need to move money from safer assets as much to the riskier assets, and that may be also a bit of a diversification for him. If he is interested in continuing to invest and be active in market, so then you can maybe bring that down to 5 to 10 lakhs. Okay, but the rest of it, I think, managed through mutual funds may not be a bad idea as he gets closer to it.
All right, Anil, I do have a lot of viewer questions for you, but unfortunately today the time on the show is up. Thank you so much for joining in and helping our viewers with their financial portfolio queries.
If you like this video, then like, share and subscribe to ET Now.